Hey guys, I wasn't gonna do a video necessarily this week, but with the price action we had this week and some other things that have happened, I decided to put out a video. I think it's important to do an update here. First of all, I want to say my previous video I was pretty bullish in the short term, but I didn't really talk about the short term. I got that wrong for sure, and I will always tell you, guys, that when I'm wrong, because that's how trading works. You're gonna be wrong. Trading's probabilities based. You're going to get some things wrong. There's a lot of these traders on FinTwit. They try to make it seem like they're never wrong. Some of them, just all they do is just delete tweets. So, of course, it looks like they're always right. Some of them just throw out random levels, and then when the market bounces 5 points off of it, they say they were right. There's a lot of tricks played by some of these guys to make it seem like they're always right, but they're definitely not. And I'm definitely not always right, not even close. Yeah, you don't have to be always right to make money in the market, but you do have to be right sometimes. I hear some people say, I'm sidetracking already and the video is just starting, so this is not a good sign, but I hear some people say that you don't have to be right to make money, and I don't know, man. Every time I've been wrong, I haven't made money, so you do have to be right sometimes, at least, to make money. I don't know where that statement comes from, but I don't know how you structure a trade where you can be wrong and make money, other than things like selling vol and things like that. Yeah, I get that. You can be wrong for most of the trade when you sell vol and still make money, but you have a lot of risk when you sell vol too. Yes, you have a high win rate, but you can have one loser that takes out 10 winners. So I mean, there's a lot to consider with selling vol. Okay, so I was wrong on, at least definitely on the short term, and probably on the longer term. My view has shifted very rapidly. I'm going to tell you why my view has shifted very rapidly. We saw some things, first of all, in price action. We saw some stuff in price action that we have not seen during this entire run-up. I'll get into some of that, but there was a 4-hour bar on Wednesday that was one of the strongest sell-offs we had seen since the COVID crash. It was the strongest, and it was one of the strongest 4-hour sell-offs we've seen. I think it was like in the top 30 in the last like 7 years, something like that. So it was definitely a outlier event that I thought about figuring out a way to backtest that, but I didn't have time. I'm not sure what the meaning is of a sell-off like that and how rapid it was, but it definitely didn't feel normal. And that's just one thing. There's a lot more that didn't feel normal about this pullback. And I think it was Wednesday when we got that extreme sell-off day, that really big day to the downside. That's when I really started to recognize that, hey, my idea to be long here was wrong. Stayed long a little bit too long, but you know what? I think we're changing regimes. I think now it's time to switch to, if you watch the previous video towards the end there, I think it's time to switch our trading style to have a heavier cash position than normal most of the time, be much more selective with trades, really require a lot of things to line up to take a trade now, either direction. We'll get into all that. So what are the things that I missed potentially? Let's look at all that. The number one thing to me, and the number one thing in this market right now, is the options market, and particularly what the vol complex is doing. Now, I don't have access to a lot of like advanced positioning data like some people have that are in institutional, obviously. But what we do have is basically what the term structure looks like and what the relative levels of various contracts are at. And this is November 22nd, before all the carnage happened in the last few weeks. We were in severe contango, 9%. I think somebody had posted on Twitter, this is one of the highest contangos we'd ever seen in the front month. And contango is not necessarily bad. It's severe contango that if you start to backtest that, returns definitely are subdued on average, heavily subdued on average, and fat tail risks do kind of go up a little bit when you have this severe contango. Here's a better view of the term structure in the severe contango and how long it persisted. And that's another thing. A lot of times when you get just this little blip down like that, that doesn't matter so much. It's the persistence of the contango that matters. And that's true for a lot of things, but it's really true for this metric. more so than any. The longer this severe contango in the term structure persists, the higher the risk ends up being. And this is something that I did notice, but I don't know why. I guess I drank the Kool-Aid and I kind of ignored these signals that were popping out that I know have value. But the only reason, I think the main reason I ignored them is because I didn't see anything with DIX and some of the other metrics that I trust. I would like to have seen at least one other thing align with the vol complex signals to get defensive quicker. I wish I would have, obviously, but hindsight's 2020. What we're doing now is hindsight analysis, by the way, and some people don't like that. And he's like, what are you doing hindsight analysis? Well, hindsight analysis to me is one of the most important things you can do as a trader. What did I miss? What could I have done better? You're always trying to improve, right? And how do you do that? You do hindsight analysis. One thing I've talked about many times is like, if you want to trade very long term, if you want to trend follow, something you should do is study what major tops and bottoms, what all the data points said at that point. What was happening here? What was happening here? What was happening here? And so on and so forth. And you'll notice some patterns. You'll notice some things that are extremely rare that only tend to happen at major tops and major bottoms. And that's all hindsight analysis. And that's extremely useful to do. This is another thing that I'm going to put into my dashboard, I guess you could call it. Stephen Harlan on Twitter posted this week about, he shared his market dashboard. And basically, it's just a bunch of data all in one spot, nice and clean. His is way cleaner than mine, which is common. Most of my stuff isn't very clean or neat looking, but it works for me. Anyways, that's kind of the way I look at the market, is I have a dashboard where I look at everything and then I make decisions. I use that as a decision support tool, just like he mentioned. So yeah, it's pretty complex. The analysis is complex. I look at a lot of things, but when it comes down to it, comes down to the actual trading, I try to make that simple. So yes, maybe I'm overcomplicating things at times in terms of analysis, but I definitely try to simplify in terms of the actual trading when the rubber meets the road. I try to keep that fairly simple. This is sector correlations, and that's another thing that's going to go on my dashboard. This is kind of like, to me, this is like breadth, but way better. And it is breadth more or less, but basically when nothing is correlated, when none of the S&P 500 sectors are correlated together on the 10-day correlation at all, that is a warning sign, especially in the last couple of years. Now, historically, maybe not as much, but that's another thing I want to talk about. When you start looking at backtests, you start looking at building models and things like that. One thing I've seen over and over again, and people will backtest things going back to like 1929 on the S&P 500. I'm not a believer in that. Regimes change, markets change. Options didn't exist in 1929. When you're building models, probably one of the most sophisticated way to build a model, and the way I think a lot of quants do it, they don't just do a back test on the entire history. They do a walk forward test. And what that is, you can look it up, but you separate out your data and you fit to the first chunk, and then you test to the second chunk, and you do that successively. Usually at least 3 chunks are done that way. So test, fit, test, fit, test, fit, test. And in doing so, you're kind of separating out for different regimes, and it's definitely a more robust way to do it. When you fit to the entire data set, you're trying to fit to multiple regimes in the market, and it just doesn't work that way. And you would have to get into backtesting to understand what I'm talking about. The point is, when we're looking at this, and why I think this has more value to look at it short term versus try to look at a long-term chart where this had a lot less value, is the regime changed at the end of the COVID crash when the Fed did record QE and the government did record stimulus. So any backtests, for the most part, should be fit to this time period for now. I think the regime is changing again. So all these backtests now I think could be somewhat irrelevant. Not completely irrelevant, but I think the regime is changing to more like a 2018 or a 15-16 type period. Maybe even worse. We don't know. Nobody knows. I think things that have worked the last 1.5 years may not work quite the same way. That being said, long rant aside again, these sector correlations have been pretty marvelous actually in the last few years. When you look at the back tests, you look at we look at this. It's been pretty consistently bearish for a few days, and this played out this time, and it's something that's definitely needs to go on my dashboard and should be going on your dashboard as well. And this is the Tradewell website, and these guys have created a really great platform, and they have a free version. They have given me pro version for free in exchange for me basically promoting it for them. So full disclosure on that. But I've gotten a lot of people ask me to promote things for them, and I've told almost everyone no. Unless you have a really good product, I wouldn't do it. But these guys have made a really good product, and I'm happy to help them with it. And there's a trade-off in that I get the pro version, which is really cool. The correlations between SPX and VVIX. This has been another very consistent thing that has worked really well. I think I got this from Rolando Santos originally, so you can go follow him on Twitter. He's a good follow. 5-day SP 500 and VVIX correlations, when they get this extreme, it's been fairly consistent with at least some weakness. Even in this crazy uptrend we've been in the whole year, it's worked pretty well. As long as we're in the current regime we are in, which, like I said, could be ending, that will be a big factor. As long as options OIs are as high as they are, I think it'll be a factor, even in more bearish market potentially if we do enter one. I think it'll be a factor still. Also, I was going to mention there's Andrew Thrasher has a white paper on, it's called the Volatility Tsunami. Basically what that talks about. What that talks about is when vol gets very, very calm, when VIX itself gets very, very calm. And VIX was overall, kind of flatlined here. Basically, when that happens, the tendency is to have a vol pop. So that's another thing you could look at. I don't necessarily have that on my dashboard, but it's still, I just haven't found a way to really quantify it the way I'm comfortable with. But I still am a big believer in that white paper if you want to learn more about kind of like left tail risk and crash risk, and how you can forecast that with just the price of the VIX. Okay, so now we're talking about some of the longer term things. These have existed for a long time. And what happened, I think, is a lot of people stopped talking about this stuff. And that's what happens. Like, a lot of the people were talking about this and we're going to crash because of this. But usually what happens is it becomes a problem only after quite a while and after people have stopped talking about it. And I haven't seen as much of this lately, but short interest as a percentage of market cap of the S&P 500 is extremely low. I always like to normalize things. And in this case, they've normalized it to market cap. And also, we have a lot of history here, which is useful. Because I've seen some of these where they're only showing like this part of the chart. And of course, that looks terrible when you do that. There's a lot of tricks played with the way people present data that makes it look different than it potentially actually is. But this is a pretty solid chart. There's been systematic destruction of institutional shorts in the last 2 years, and in my opinion, shorts are needed in a bull market. If you don't have enough shorts in a bull market, fat tail risk starts to increase. That's why I think right now fat tail risk is probably as high as it's been probably since prior to the COVID crash. Now, when I say fat tail risk is high, I'm going to say it's 5%, maybe 10% max. That's still a low percentage. It's still fat tail, right? So it's still going to be a low percentage. But typically, fat tail risk in most conditions is less than 1%, probably way less than 0.5% actually. To say, if I'm sitting here telling you 5% fat tail risk, that's a lot. That's scary. It's not saying we're going to have a fat tail, because I'm saying 5%. So people will get confused by that, I'm sure, but I'm not too worried about it. Margin debt, this has persisted for a long time. We've seen a lot of margin debt. There's problems with this way this chart is presented. I'd like to see it on a log scale, but pretty scary. A lot of margin debt. We've had a lot of margin debt for a very long time, and the longer this persists, the bigger the eventual correction to correct that will be. This is kind of a better way to look at it. I've put both of these on log, I think. Yeah, both of these are on log. Index and margin debt. And yes, you can see margin debt exploded way back in 2006. This has persisted for a long time. And because the market cap has exploded so much recently, it looks a little better. The ratio is still a little better, but we're still way above 1. We're at 1.77, so there's 1.77 margin debt for every market cap. That's a lot, and it's been that way for quite a while. So eventually, yes, we're going to correct this in probably a pretty nasty way. When this margin eventually decides to unload, and I do believe that the fat tail resides potentially under 4,500 on S&P 500 on ES. You could start to see margin calls. I don't think we've had margin calls come out yet, but under there, I think that's where you start to see the margin calls, and that's where to get a crash, you've got to get a rapid sell-off, and we've had a very rapid sell-off. You've got to trap people rapidly. That's how you get a crash. Now that people are trapped, they haven't had a bounce to really get out. And I can show you an order flow. Maybe I'll show you. Every bounce, there's a lot of icebergs, people trying to get out, at least on ES. There's not enough liquidity. Liquidity gets pulled away. All the big vol sellers have been killed the last few years. In 2018 and 2020, a lot of vol funds blew up. I don't think they've all come back. That's why VIX has been higher than. And every time we pull back, we have a huge VIX spike. And part of that is because I don't think there's as much institutional vol selling anymore. So there's nobody hammering VIX back down. That does set up some fat tail risk. That adds to the fat tail risk. This is another way to look at margin debt, and I think perhaps I like this one the best. This is margin debt minus free credit. So this is basically in trading accounts. Margin debt adjusted for the amount of cash in the account and for market cap. And almost a record low. The record was right before vol apocalypse. So this is that adds to fat tail risk, and this has persisted for a long time. This is a chart. This really, to me, this chart here typifies 100% the euphoria we've seen in the last few years, and especially recently, we have this huge ramp up, and then you just get another gigantic break of the uptrend line, basically. This typifies the euphoria for me pretty well. Yeah, and we're on log too. That's what's crazy about it. No, we weren't. Now we're on log. Okay, even on log though, you see, yeah, it's accelerating in this last. So you had the October correction, right? And then people accelerated their purchases, leverage long ETFs. And don't get me wrong, I love to buy and hold leveraged ETFs. I buy and hold some leveraged ETFs. But there's a risk when you do that, because if those things are levered to daily returns, okay? And so if you get those 3x ETFs especially, if you get day after day after day that's way down in a row like we had in 2020, those will go down way more over like a 3-week or 4-week basis than the underlying, even multiplied by 3. So look at like QQQ versus TQQQ during the COVID sell-off. TQQ sold off much more than it should have if it was just 3x levered to longer term returns. It's 3x levered to daily returns. And we start looking at the math behind that, you can understand why it can go down a lot faster than it should. You definitely don't want to be holding those when fat tail risk is elevated, or certainly when we're in a bear market. Yeah, they're great to hold most of the time, but not always. This is another thing that for a long time we've had retail just nuts with the call buying. And I've shown you an open interest before that this isn't staying overnight. It's mostly used during the day for extra leverage. So it's not as bearish as the chart looks, but still this is record high speculation that we're seeing. I prefer this over the put call ratio because this is from the OCC weekly data, which actually shows the side that people are on, that the specs are actually on. Because volumes don't tell you what side people are on. Not necessarily. But this actually tells you what side people are on. This is more or less the commitment of traders report for options, more or less. And you guys know that I do like the commitment of traders report, although commitment of traders report, really good for commodities, not quite as good for stocks, but I still think it has some use for stocks. Hedge fund exposure. This is another thing. I saw, what day was that? Well, that was probably last week. Yeah, that was actually last week. Yeah, but this is always a little bit delayed. When I saw this ramp up this week, when this finally updated, I was like, oh yeah, I need to adjust here. I'm not on the right side of the market here. So I adjusted. This is one of the things that I've trusted the most over the years, and you guys that have followed me for a while know that a lot of people have this myth about the market that you can just follow the institutional money. Institutionals always know what they're doing. They always print money. In some cases, I think that's absolutely true. I think there are some trading desks at some of the big banks and some of these other places that are highly secretive. They're not public. And they don't have to be public. And I think they have PhDs building quants and algos that are killing it, most likely. And they have huge informational advantages. So I'm sure they kill it. But a lot of these public hedge funds, you can look at their track record. Most of them don't do that well. So I'm all about counter-training the hedge funds, man. I'm a contrarian towards the hedge funds most of the time. And the backtest of this proves that out. So you can backtest this. And what this is it compares the hedge fund exposure returns versus the stock market. So how these equity hedge funds are doing and versus how the stock market's doing. So what this is telling us here, this tiny little dip here back in when it started in late November, this tiny little dip, and hedge funds got slammed. Their returns plummeted. So what's that tell you? That means they're heavily levered long. I don't view that as bullish. That's a little scary for me. And we've seen it took them a long time to get behind this trend. They fought this trend, especially early, really hard. Briefly got a little bit extreme, but they're still. And then here, yeah, for a bit we got a little bit bullish, but then they sold immediately. And then finally, big chunk of really bullish now finally by the hedgies. And part of the reason, I wasn't super concerned in my last video is they were back down here. But, you have a history now of several months where much more bullish than normal from hedge funds. Another thing that's persisted for a long time, and we all forgot about it because it's happened for so long. Everybody keeps talking about breadth is bad, we're going to crash. Drawing all these silly charts and stuff. So anyways, breadth's been bad, and breadth has been bad the entire year. And when it persists for that long, that's when the breadth divergence starts to matter. A breadth divergence that persists for an entire year is a bigger concern for me, for sure. I did talk about this in the last video, but FMS, the fund managers, are way overweight U.S. equities. And, I don't have data on this, historical data to test this, but this is 1.6, 1.5 Z-score above average positioning by them. And they've been that way for quite some time. It's persisted for a long time. The longer something persists, the more it matters. It's starting to matter. What happens if we start to go down and the margin calls come in? There's a lot of people off sides right now. And I've shown you in the positioning already that I've shown you, and there's a lot more to come. That's why fat tail risk is elevated, because we've had a rapid sell-off. People couldn't get out. And there's more reasoning. Large specs are crazy long on COT. Now, yes, I know COT a lot of times is used for hedging. So there's a grain of salt on this kind of thing. And yeah, small specs did drop quite a bit, so I guess that's encouraging. This is from Sentiment Trader. I don't know if I like this chart that much, but I thought I'd show it to you. This is Hedgers. So this is using the older style reports, I'm pretty sure, where they're talking about commercials, which is different from the disaggregated reports. Disaggregated reports came out, I want to say, in like 2006 and separated out the commercial and non-commercial categories. Some people still prefer the old reports. They still do the old reports. So the old reports, hedgers were considered commercials, which on the disaggregated, that's asset managers and dealers, I think. Yeah. But when I tested all this data, I went into this data pretty extreme at one time. I found that asset managers aren't necessarily that great anymore at being a contrarian. They're not necessarily hedging. I think there's a lot of speculation going with futures by asset managers, but dealers are only hedging against speculator positions. So I prefer disaggregated reports with the dealers. That's the only thing I really look at with equity COT. And that's what this is. So this is what I created. It takes all the all the futures contracts, combines them together. All the equity index futures contract combines them together, and I'm only looking at dealers' net positioning as a percentage of the open interest. So again, normalize it. I like to normalize it to open interest. If you don't normalize this to open interest, this thing is in such a gigantic uptrend. It's really hard to make out the data. So you have to normalize it to open interest, because futures have continued to grow in interest, just like the options market has. The futures has also seen a lot of growth and a lot of people using it more and more. And slight uptick in dealer longs this last report is nice, but overall though, when you look at this, we're going to adjust this for 1 year percentile. That's what this is. Yeah, it's pretty near a 1 year low. And this has been pretty low for quite a while now. 2 year percentile. This is pretty low on a 2 year percentile basis, like 20th percentile right now. 12th percentile maybe. That looks like, yeah, 22 percentile, 23 percentile. 5 year, we're at the 27th percentile on 5 year rolling percentile basis. So dealers are much more short than they have been in the last 5 years on average. The sell signals on this are not quite as good as the buy signals. That's just the nature of the way anything works on the S&P 500. That's just how it is. You don't get as clean of sell signals as you do buy signals on the S&P 500, just how it is. But the buy signals, this is what I talked about last week. You get some incredible buy signals on this. I mean, look at this. Look at these places you could have bought with this and how good it was afterwards. People are saying, that's only because of QE or whatever. And yeah, okay, maybe. But next time I see this signal, I'm going to buy it aggressively. That's why I did the research. So when this happens again, I have the confidence to buy. That's why you do the research. I mean, me sitting here telling you isn't going to give you the confidence. You have to do it yourself. I really believe that. So get out there, get to work. Yeah, so another thing that maybe long term we should have thought about more is this is a little bit delayed. This happened quite a while ago, but insiders sold like crazy a while back. So when was that? This was clear back in April, but the insiders did sell pretty aggressively. I don't know. Insider selling, not the most amazing signal ever, but I do look at it. It's on my dashboard. Seasonality, this is another thing. You know, I was kind of pushing this as well, so I'm not criticizing anyone. If anything, I'm criticizing myself. I was one of the ones that said, hey, seasonality is good. I see not enough things to be worried about. We should go higher. Oh, that was wrong. And in hindsight, I was seeing a lot of people say that, and that should have given me a little more pause than it did. Way too many people were caught on seasonality in the Santa rally. And I've said this, I think, before, but big outlier moves. And I know we're only down like 5-6% from the highs, but it happened fast. It was kind of an outlier move in terms of rapidity of price move. You get big moves like that when the market moves counter to seasonality. Look at 2018 when we went down and set it up for the Santa rally. You get huge moves when it does not. Doorbell. Oh yeah, I'm back. Yeah, the visitor seasonality is what it is. I think I talked about that already. Tail risk. This is an elevated tail. You don't normally see a distribution of returns quite like this on most back tests, but VIX between 31 and 100, you do see that. This is Tradewell again. I also did the Tradewell back test. I just did it 30 and higher. You can see there's definitely elevated tail risk. Normally this should be much smaller of a tail. And this is only looking at VIX over 31. I don't think there's a way to back test this, but if you had VIX over 30, if you did a back test of VIX over 31 and the amount of leverage that's in the system, if you had some way to quantify all the leverage in the system into one number, I don't know if there's even a way to do that. VIX 31 with the rapid sell-off we've had and with the leverage that's in the system, I think the tail risk would be really high. My guess is like 5 to 10%. I'm just throwing a random number out there, but that's kind of where I'm at on the tail risk. It's there, it's present. 5% still a small number. I'm still looking to buy this market when I get the buy set up. We're going to talk about that. I think it's a little too late to short now. Although, yeah, if we get the left tail, sure, I'd love to be short for that. I just don't know how to short when we brace sold off this much. It just doesn't really fit with the way I like to trade, especially when I'm seeing enough data points that line up that say we have a pretty good potential of a pretty big rally. If nothing else, a relief bounce coming. These kind of markets are super random. You never know what the market's going to do ever. But in bull markets, I think I've always found bull markets to be more predictable. I like bull markets more because I think they're a lot more predictable for somebody that looks at the data. Bear market's just so much randomness to it, very emotional and news driven. And I'm not saying we're in a bear market right now. We're only down like 5-6% from the highs on the S&P 500, but a lot of stocks are already in a bear market. A lot of people are way underwater already. So, and these corrections do act, at least short term, like a bear market. Even these corrections we've had this year, I mean, you get price action that mirrors bear markets. You get a lot of false bottoms. You get a lot of bull traps. You get a lot of bear traps before you finally get the reversal. Even October in that correction, you had quite a few traps before we finally reversed. Gamma trap, this also adds to the fat tail risk. There's a huge amount of puts at the clear down at the 4,000 strike. These were at like 4,400 earlier in the week. They rolled them all the way down to 4,000. So under 4,500, which I've been saying this for a while, for a few days now, and he's saying it today, and I agree. Under 4,500, that's where we have a lot of trouble. When I saw these roll down to 4,000, I was like, oh, this isn't, this is not ideal. This adds to fat tail risk. Another sign to be extremely careful here. If there is a way to get short under 4,500, I may try to do it. It's a risky short, but the reward is potential 4,000 quickly, and that's extreme. I know that's quite a sell-off, but we have the fuel to do it if we can hold under 4,500 for a while. The fuel is there for that. There is a big chunky puts at 4,400 too. That could hold us too. That's possible, but Yeah, there's a pretty big void if you can get through 4,400. So I mean, I don't root for bear markets. I don't root for carnage or anything like that. But the only good thing about a bear market is it does eventually set up another bull market. That's what I like about bear markets. And there's nothing more beautiful than the early part of a bull market if you could recognize it before the masses do. And the only way you're going to recognize it for the masses is to put the time in and research it. This is another thing that, like, when I saw this, I was like, oh, this isn't so good. I got to change my view, man, because we had just started kind of dipping, and the social sentiment on Twitter, according to the way Sentiment Trader analyzes it, I don't know exactly how they do it, but people were mega bullish at the highs here. Some of the highest bullish percentage on Twitter ever. I believe this only uses Twitter. So that's a red flag. Something we haven't seen yet. There's been a lot of bullishness, and bullishness in a bull market is not necessarily bearish. People will look at sentiment. If you're gonna, and I do look at a lot of sentiment data, but if you're gonna look at sentiment data to analyze and set a bias for trading, there's so much nuance to it that there's a lot of nuance to it. It's just because people are bullish in a bull market, it's not bearish. Very, very bullish after a huge run, and we're not early in the bull market anymore. Early in the bull market, a big shift to bullishness, that's actually a good sign usually. Late in a bull market, extreme bullishness like that, that's typically not good from my point of view. You can see annualized returns when we're below the extreme, so below that red line, or 4%, so way below average annual returns, which is around 7%. And yeah, we're way under the red line. That's a red flag for me. I've never found any of these social things to work that well when I start to actually test them, but I do view this as a red flag. Although this one does test kind of well. I mean, you can see the test right here, basically. It's just using automated natural language processing messages corrected on Twitter. That's what it's using. So there's a lot of these out there. A lot of them I haven't found enough data to test them. This one at least has data, you can test it, and it does have some edge. There's another thing, so the week of December 1st, that was this week. Yeah, so the week ended December 1st. Huge inflows. I mean, look at that. The biggest inflows we've seen in, well, the last month, but right at the highs. And actually, this is after a big pullback. So people are aggressively buying this dip, which has me a little bit nervous here because I always prefer to see outflows in a dip. Instead, we're seeing huge inflows. Okay, here we go. This is something I came across recently. VandaTrack, retail track of retail net buys. And yes, all year when they've bought the dip, it was the low or pretty damn close. So retail's not necessarily always wrong by any means. A lot of people get that confused. The retail is always wrong and all this. Not necessarily the case. But man, when they get this aggressive and we got all this risk now built up in the market, that's makes me nervous as well. I mean, this is one of the most aggressive dip buys they've done yet. I'm not loud about AAII, but they have backed off a lot. So this is a little bit adds to potentially a bounce case here. We're going to start getting into the bullish stuff now, and why I think we still have a decent setup for at least a relief bounce here. But I think this correction at a minimum, if this ends up just being a correction and we just resume a bull market, which I'm a little bit iffy on, but say that happens, I don't think it's just going to be a V bottom and then back to new highs this time. I think it's going to be a kind of a lengthy correction and potentially one that makes a lower low after the relief bounce. I think lower low after a relief bounce here, I think has a good possibility. This is COT again. This is a sentiment trader's version of it. A 1 year stochastic of spec positions. It's pretty low on a 1 year basis. I was supposed to put that, I think, earlier in the video, but there it is. AIM model, so that what this does is Sentiment Trader takes, and I'm really appreciative for Sentiment Trader of allowing me to put these up. I don't know, they technically don't really allow this, but they've never said anything, so I do appreciate that. Technically, I'm not supposed to be doing all this stuff, showing all this stuff to you guys. Someday I might get in trouble for it. The advisor and investor model takes all the surveys and basically compiles them. And I would really prefer to see this be much lower. Yeah, a lot of people are still holding on to pretty bullish views here, even after the rapid sell-off we just had. NAAIM, this is institutional money. They're still quite bullish here on the last survey. BofA Bull Bear is still fairly neutral, so we haven't seen a big reset in sentiment like I would have liked to seen with. We've seen some pretty big carnage and not much of a reset in sentiment, so that's a little bit scary. Bullish things though, DIX is still fairly bullish, and this is one of the things that kept me kind of bullish at the highs, because we had a 47 print there right near the high. I didn't see a DIX sell signal. Sell signal. I have my version on the YouTube. You can find it. I did earlier this year. And DIX is still buying. So back in March when we really started selling off, they wouldn't get over 40 at all. They did get 1/45 print here in this little bounce, but that one failed. Not every 45 print works, right? And as soon as we started selling off hard, they went way under the 40 mark, which is your sell mark. And the fact that they haven't done that yet has me thinking that we may still get a pretty nice bounce here, and I think it might be tradable. That's still the side I'm leaning on here, but like I said, I'm shifting to higher cash, and I'm going to focus more on swing trading and not just, you can't just get long now and expect to just hold it for months and weeks. I don't think you can do that, at least not for now. If conditions change, we might be able to go back to that, but I have the suspicion that we won't be able to do that for quite some time now. Looking at this, this is one of the indicators made on TradingView, Major Equity ETF DIX. This is a very long-term moving average. We are printing above average on Equity ETF DIX. Not as useful, but still something to look at. FANG, this is a very, very long-term moving average of FANG. We're just barely above average here on a lot of these prints. So I'd like to see that better. I mean, these are your bellwethers, and they're not getting a lot of DIX buying support. But some, definitely, it's definitely above average. Maybe it's enough to get a bounce. I don't know. This is something that I noticed as well this week, is that this liquidity premium, which has been very reliable in this new regime post-COVID crash, every time we've had a correction, people rush to SPY instead of the underlying stocks. So all this is saying is basically the volumes on SPY are much higher relatively than the underlying. Basically what this is saying, I'm pretty sure. If you have Sentiment Trader, you can read through all this, or pause this and read it. ETF volumes, yeah, that's what it is. And I would love this should be up here right now, in my opinion, and it should have been there probably much quicker than now. And so but it is getting there, so this, I think, does start to now add to the bullish case. People are starting to rush to safer issues instead of individual stocks. So my plan, this gets down to the plan right now. Anybody that's a volume profile, market profile guy, we have what a lot of people would call a poor low. Now, the thing about ES and the S&P 500, you get poor lows all the time actually that end up being bottoms. So it's not like it's not a thing that's like you have to have like a good low put in where you get a tail.
Something went wrong. Try again in a few seconds.
Sorry about that. Google's talking to me. You don't have a selling tail yet. I would love to see that. If I saw that, we wash out under 4,500. You get a selling tail. I would take the trade here if we had seen that. Now, I'm not taking it on Friday going into the weekend, but if I see that Monday or Sunday in Globex, I may take that trade. I think that could be a durable low if we get that. You get a big washout of the stops under here, and you get the rapid rise back above 4,500. That's where I get interested. I'm not interested in trying to mess around down here with longs. I want them back up here. The way I approach short-term trading and the way I approach price action, the way I approach order flow, markets, in my opinion, a lot of times do tend to reverse once they take out a major stop level. That's it. That's kind of the way I approach price action. Yeah, one of my main, I guess, influencers of price action analysis is Adam Grimes. Yeah, if you read his book, the way he analyzes price action is kind of the way I like to analyze price action. So there's a book recommendation for you. But yeah, I'd love to see like a big washout of this and then a quick recovery, like not a slow motion recovery. I want a quick recovery. That would tell you that they hunted the liquidity, they got the liquidity, and now they're buying it back up. That's what I want to see there. But like I said, this market puts in tops, it puts in bottoms that have poor lows. Oh, this is a good high here. Nice tail there in the high. And let's see here. This was a short I think I tried that didn't work. Just so you guys know. A little swing short that didn't work on the way up. This yeah, so this is kind of a poor low, man, but it was the low. Like we get, especially with the options, when it hits a major OI level, it can just stop and just flatline. You don't have to have a tail to get a buy. So don't think we have to have that. My plan is with this, if we get this set up, I want to buy here. And of course with stops, with risk management, all that stuff. It's not just buy and just hold, right? Or if we just chop around down here more, I'm not interested till above 4,600, just like I said on Twitter. Now, here's an example of a good high. You get the stop run. Granted, it was brief. And yeah, we stop run 4,500 too, I suppose. But it's Friday. It's a little different. Got to be careful with that kind of stuff. But yeah, even here, if I'd have seen a bigger rally and then a stop run, of course, I probably would have tried to get long here because I said over 4,600, I'm getting long. And if we just closed a couple bars up here on the 15-minute chart, I would have started looking at longs. But then if that would have failed, it does set up quite a good short if it does then fail. But this wasn't quite as good of a short because we didn't get quite as aggressive of a stop run. But in the Discord, I was in there and I posted. I didn't have access to order flow on Friday, but I did post. I was like, it looks like it's going to 4,500 just from price action alone. And there's a lot of value. There's a lot of value. We do all this. I do all these back tests and I show you all this data and stuff. There is so much value in just watching price all day, every day. There's a lot of value in that. You'll just pick up on so much nuance that I can't even put into words. You just have to do it, man. if you want to trade, man, you can't just listen to me or anybody. You've got to do the work, man. You've got to start watching this stuff, and you've got to like start committing things to the memory bank. A lot of it is even like subconscious almost. It's not even, I don't know, just watching price action I think has a lot of value. I'm a big fan of just naked price charts. I mean, yes, I have volume profile on here, but no, it's just, you know, if I have a bias, I'll use the volume profile, you know, to kind of find levels. I don't use volume profile so much for setting bias. That's kind of everything else. Some people do that and do succeed with it. I don't think that's a problem to do it that way. That's just not my way of doing it. The volume profile is useful for levels for buying or selling against. Let's see. Looking at my notes here. Yeah, so just looking at charts, just looking at price action on the Qs. The Q still looks intact to me. Like, it hasn't fallen apart yet, and you still have pretty good dark pool buying overall. Although, yeah, I mean, this is probably way above average dark pool buying on the Qs. Nasdaq. Russell though, Russell's broken. Russell's not going to set up, to me, Russell won't set up for a long-term now maybe short-term, it could have a big bounce at any time. He's sold off a lot, but long-term, I don't think this is a long for quite some time, which this is going to add pressure to the entire market that this thing is so underwater now, and they've trapped so many people now. Massive failed breakout look there on that. I think this chart has a lot of work to do before you can look at buying it long-term. Short-term trades, yeah, they're probably there. But, yeah, and dark pools are also not too keen on the Russell right now. Definitely below average long-term on the dark pools for IWM. On the other hand, semis, you could look at this two ways. One, the chart is still very much in an uptrend, still bullish, I suppose, but toppy kind of action up here with high volume. Very choppy, extremely volatile at highs. I've always kind of felt that that's a little toppy. Uptrends should be low volatility typically. When they start to get high volatility, that can be an issue. But some people look at the semis as like a bellwether kind of index for the market as a whole. I don't know about that, but I like semis. I've been long semis for a long time, until recently. So I think they are, I don't know, I think they're important to look at. I don't know if they are the leader or anything like that, but a lot of people think that. Equity hedging index. Here's another thing. We were unhedged for a long time according to this. You can see how this is calculated right here. They finally are hedging now. So is it too late? There's a lot of people underwater now, so it's very expensive to hedge now. So now all of a sudden you want to hedge when it's extremely expensive. I think this adds to the bounce case here. That's why I'm still going to try to get a long. It's not a long that I'm going to ride necessarily all the way to all-time highs. It's a long I think you can get a couple hundred points out of, though, on a swing basis. Going back to my last video, it's talking about the credit spreads. We have seen, this is another thing, we didn't see any warning from the credit markets, and the credit market's still pretty healthy. But this is a website that it's credit spread alerts. Very cool that I ran across recently. So I just want to mention that. What else? I think that's the end of my charts. Yeah, I talked about my trading style. HorseLover Fat on Twitter gave me a shout out. The man has 25,000 followers. So there's probably a lot of new people to my video. That's why I've tried to explain everything along the way this week. Shout out to him. I really appreciate him doing that. And nice guy. I've talked to him a few times in private messages, mostly about PineScript, but